Soon to be live, and we are live on all platforms. Welcome back to Deal Flow Live. This is the show where we talk all things deal making, business acquisitions, business sales, and everything in between. And we talk about listing prices. We talk about the price of the business, whether we think it's appropriately priced, who we think it would be a good acquisition for. And we talk about what kinds of details you should be aware of if this is something you're looking to buy or if you're looking to sell something like this. So welcome back to the show. I'm your host, Brody Vinson.
I'm your other host, Ryan Santa.
And tonight we have on a very special guest, Ayman Shamaa, who's been in deal making for quite a long time now. And he's got a very particular industry that we're going to dive into today that he's got a lot of experience with. And so we're going to get a little bit into that, a little bit into, how this industry works, why he likes it, what he doesn't like about it, what he does like, and some particular deals that we found ahead of time that we're going to kind of break down. We're going to talk about the numbers on them. We're going to talk about what kinds of things you should be aware of in this industry. And we're really excited for it. Ayman, thanks for being on. And to give the viewers just a little bit of sauce on you, I would love if you could just give us a little intro to you, how you got into deal making, and what industry we're looking at tonight.
Well, I really appreciate that introduction. That was far too kind. So thank you, Brody and Ryan, for having me on tonight. I'm pretty excited for us to get down to some numbers and have some fun. I have been in the space of M&A and acquiring some businesses now almost going on 15 years. So I originally come from a finance background as well as a business development background. And one of my best friends I've known for many years is a pretty successful dentist. And so he came to me back in 2017 and he was like, hey, man, seems to be this market share that's shifting in dentistry. And it's not really something I understand. You mind taking a look and let me know if you think we're onto something? And so I was like, I don't know anything about dentistry, but I know businesses. Let's look at the numbers and kind of see what that looks like. And holy crap, was he right, man. It was at that time there were so many solopreneur doctors that were just figuring out business like as they go along. Like it was like the business world and like circa like 1920s. That's like literally how outdated it was in so many processes, and obviously a lot of those have been refined now, but as a whole it's been a very interesting journey, and I'm excited to get into it and talk about some of the deal flows that we've looked at, some of the deal flows that we are looking at, some that we've purchased recently. So I definitely think this will be a pretty fun episode to get into.
I love it. Thanks for that introduction. I think the best way for us to kind of get into these is always to like start looking at the numbers and just hone in on a particular deal. But for anyone who's tuning in, one thing I always like to say is ask any questions that you have that come up, even if they're for different industries or something else, something completely different. Ask away and we're happy to answer your questions.
Especially on an episode like this, like trying to lock Ayman down takes months at a time to get him to have availability. So you may not see him for another 6 to 8 months. So ask him now.
Well, as it happens, he might be coming on a little bit sooner than that, but
thank God.
Ask away any questions that you have. If you've got anything that relates to the industry or just deal making at large, business consulting, he knows a lot about the space. And we would love to answer your questions. But the first deal that we've got here tonight is this one out of New Jersey. So this is a comprehensive oral healthcare business out of Camden, New Jersey. They're asking $6 million for the business, and it's doing about $1.26 million in cash flow per year. Right off the rip, Ayman, what do you think as far as like the numbers of this business?
I mean, their valuation seems to be a little high, in my opinion, for what their cash flow is. And what's really interesting about dentistry as a whole is there's two predominant numbers that make a really, really big play on evaluation. So production is the term that all dentists usually use when they're talking about that number. But a production number actually refers to the total amount of money that's charged for the dental service performed. So I want you to think about this of like the gross number. The collections is what we really care about because the collections represents the actual amount of money that the dental practice received from the services. So they may say like, hey, our office has had, $1.2 million in productions. It's like, that's cool. I know plenty of businesses that have had, 7-figure gross revenue numbers. What's your net income, right? What's your net revenue that you're coming from? So a number one thing for this industry that you want to ask is what their collections were, because a lot of insurance companies, they actually will pay half of what the dentist or whatever clinician is charging, and a lot of people don't know that. And that's why you have a lot of practices too, like for their like big cases, they just go cash only, they don't do insurance. So based on this, from what they're asking and what they're making, I'd probably say their multiple is a little high, and I'd probably say their valuation is a little high. Knowing this business, I'd probably say their real cash flow is probably somewhere around 800 grand if I had to guess.
Interesting. So you think a lot of times the cash flow is a little bit inflated in these cases, if you were to dig into it and kind of get an idea of like how the numbers actually break down?
Correct. Yeah, I do. And it's interesting because this is one of the few industries where the cash flow is actually overstated rather than being pretty precise. And again, it goes back because they're using the word productions versus collections. And the whole point is we want to see collection. So if there was like quotation marks that said, hey, we're 1.2 in collections, all right, I'm excited. My ears just perked up. That's a deal I would entertain looking into, but I would probably wager 99% that's their production number, not their collection number.
Interesting. Okay. So those are one of those big details where like if you guys are tuning in, if you're looking at getting into an acquisition of a business that you don't necessarily have a background in, this is why it's so important to partner with someone who's in the space and actually understands the ins and outs of it, because you might really overpay on a business just not understanding what the actual cash flow and what actual cash collection you can expect from owning it is. So you've got to actually talk to people that are in the space that understand it at a high level to be able to break these things down. It's just yet another really extreme example of that. You see that in a lot of different industries, and it's always different. So look for collections versus production in dental practices.
Okay.
Other than that, we've got a few other details to look at here. We've got 14 employees. The place is leased, and it looks like there are 2 5-year options remaining on the lease. So they've got some good runway on that. Let's see. They want to transition the business over an 8-week period.
That's a red flag.
Yep. Let's talk about that a little bit, because I think this applies to really any kind of industry and any business. When you say transition it over an 8-week period, or when you say that's a red flag, talk a little bit about that and talk a little bit about why. I have some thoughts as well, but I would love to hear yours.
So there's 2 immediate red flags that I see looking at this deal, right? The first of it is the multiple. That's a 5 times multiple from what their cash flow is to what they're asking for. And dental practices on average, their multiples are usually between 3.5 and 7. But the 3.5 multiples are usually for practices that are making less than, I would probably say, 2 million. So the fact that they're going for the middle ground between that valuation tells me that they're getting top dollar. And usually any of the dental offices that are at 5x multiple to 7.5 multiple are sitting on real estate and a building that they own. So if you're telling me that there's no land deal in this and there's no building deal in this, which is only important because that's a hedge, right? The business could ultimately fail as an example where you're still sitting on the assets of the building and the land itself. And so you also can use the depreciation of the land expense and of the building expense to actually offset your books, which gives you more income that you get to keep. So the fact that they're going at a 5x multiple and that's a lease space, that tells me that there is a financial issue with this practice. Most likely, over the years, what I've seen is either a doctor is exiting due to wanting to be in retirement, and a lot of them, their succession plan is literally selling their practice, which is not a good thing, as you know, Brody, and you know, Ryan. And the second piece of it is either somebody is having a life issue that requires them to get out very quickly, or thirdly, there's a monetary issue that, you know, they basically need help in order to keep the practice afloat. And I'll definitely tell you, practices require a lot of money to stay afloat. And if you're in between 700,000 to about 1 million in, let's just say as the example, in productions, then at that point, that's just when the gravy starts getting real good, right? So he or she that owns this practice are most likely in a position where they just need a little bit of money to get out of this deal, and they probably are just ready to move on with it. So 8 weeks, to answer your question, is a red flag because that shows me that there's time value decay. If you have a good business, you don't care to get out of it in a specific time period. You want to get out of it over a time period that's sustainable for you to get the maximum price. So that right there tells me that there is some type of a pressure that's coming from somewhere. And coupled with the valuation and the timeline, it tells me there's either a health, life, or financial strain that's playing into this.
That's a really good point. I think it's so important to look between the lines like he's doing if you are looking at buying a business, because there are outside pressures that come into it, and if you don't recognize those, there are potential skeletons in the closet that you might miss. We actually have a question that came from someone on Instagram. If we want to get into it, it comes from Diego .0830. He says, when you're looking to acquire a business, do you think of the deal structure by using outside investor leverage, or are you looking to buy the business outright? What do you think, Ayman?
That's a great question. I would probably say it depends on the industry that you're in and the amount of money that you're buying into that business. As a whole, as from a business consultant perspective, as well as from a private equity perspective, we want to deploy the least amount of cash for the most amount of value recapturing. So if we can do seller financing over a course period of time and only give them 10% down, we're going to choose that option, because then we can take the money that we have and have that work for us for the business. So all in all, it really just depends on the industry, because also in that same line of thought, if you're buying a business that's really not that expensive and you can just buy it out and do what you want to do without having to carry a note, preferably with a business owner that's selling, then at that point, that makes more sense. But I think it really just depends on the deal. But to answer your question, Diego, for the most part, you want to do seller financing or some type of creative financing vehicle to maximize the monetary usage that you have at your disposal.
It's a great point. And I think it just depends. I mean, like he said, it depends on so many things. I think a big one is, what is your financial standing currently? And if you're in a really great financial place, if you've got massive sums of money saved up and you might be able to bring some of that capital in yourself without chipping into your personal net worth too much, the actual percentage of it, then you're able to get equity. You're able to get a larger amount of equity in a business a lot easier. And you should still be very careful and make like considerate choices and not overpay for anything, and try to get as good of a deal as you can. But it does give you more leverage. But if you're not coming from that place, as most people aren't, most people might be getting into a deal and not looking to spend a significant amount of their own personal wealth. Bringing in outside investment could be a really great way to do that.
That's right. Yeah, that's exactly correct.
Great question. And for anyone who's tuning in, feel free to ask any questions like that. That was a great one. So let's hop to another deal. The next one that we have is actually around the same cash flow wise, not too much lower, but a pretty significantly smaller asking price. That being said, Ayman made a great point, which is that sometimes the cash flow is overstated on these. Let's dig into this one a little bit and see whether that seems like it might be the case, whether this one's different. There's a little bit more to go off of in this one too, in that it looks like there is real estate involved.
Mm-hmm.
We'll have to dig in and see whether that's part of it as well. But we've got an asking price of $3.79 million. We've got cash flow of $935. So that puts it at probably just a little bit lower than a 4x multiple, or right about. What do you think of this one right off the rip?
This is looking a lot more on brand. So that multiple looks like it's somewhere around 3.7. So that is on par with the starting multiple for a practice. So that tells me that they're conservatively gauging their practice as well as the asking price. This off rip I already like because that tells you that the owner or whoever's selling this practice knows what they're doing and they're trying to start at a place that would be a pretty fair negotiation, if you will, right? So far, this is off to a way better start than the last deal.
I think so too. We actually have another question too. So we have a question from Yoshi Pachi, someone who tunes in pretty regularly to the show now. So great to have you back. He says, what industry indicators do you usually look for when you're looking at target companies in a specific industry? That's a great question.
That is a really good question because that's going to vary on the industry, but I'll try to give the best top 3 that I can. I would probably say whether they're going off of EBITDA or if they're going off of another form of evaluation of their company, what their overall 3-year minimum profit and loss statement has been. And I'm also going to ask for the balance sheet and the income statement. Those 3 things coupled together will give you a really good idea, no different than when you're looking at a 10K before investing into a company in the stock market. So if I could only go off of 3 indicators across all industries, those would definitely be the 3 that I would look for.
That's great. And I think the double click there is like there are insights that you can get from those things. So one that comes to mind immediately is like, what is the actual growth rate on the profit and loss statement? Are they in a state of growing year over year, or are they on the decline? Right. That's something that's important for you to know, because if you're looking at buying a business, it might be a really profitable business, but it might be on the decline. In my opinion, that should factor into your decision. You might not want to pay as much for something that clearly would need some help in getting back into a growth state. And you would want to figure out why it's not in a growth state too. I think another thing that you can get from that is you might be able to review the profit and loss statements and the other statements with someone who is in the industry and is a professional in the industry, maybe someone else who has a business in that industry, and say, hey, how does the labor look here? Does it look like they're overpaying? Does it look like they're underpaying? How does the cost of goods sold look depending on the industry? Are they overpaying, underpaying? Is this high or low based on your experience? And you could start to identify opportunities that you might not have otherwise seen and get insights into, like, the whole point of buying a business is you think that you can make more money owning it than it took to buy it. So if you can start to see those opportunities where you might be able to grow it and you might be able to optimize it more, then those are really good things to look for. What do you think, Ryan? Any other indicators that you would look for?
No, you covered them, man. I was trying to I was hoping you'd miss one for me, but you got them. You gotta leave me something, dude.
Anything else that came to mind for you? I mean, I know it's hard to answer as far as like any industry, but any things that you would look for?
I think you covered the majority of them, to be quite honest. That's exactly what I would look at, plus the ones that I mentioned as well. I think if you're starting with a 3-prong attack, which is your first baseline of assessing a business sustainability as well as the scalability, then from there you can get into better nuances, such as more of the details of, what their cost of goods sold is, or what their overall business expenses are, what their gross revenue is. All of those things you're going to see in the income statement or retain earnings. And at that point, you're really going to be able to understand, okay, hey, this business may make a ton of money, but the profitability is like this big, right? Or a business makes okay money, but their profitability is this big, right? So you're able to fit that a little bit more. So I think one of the most understated parts of buying a business is just because there's 2 commas in whatever revenue they're pulling in does not make them a successful business. Because there are plenty of businesses and practices that I've come across that are making 7-8 figures, but their profitability is like in the single-digit percentage, and I wouldn't touch that business with a 30-foot pole. So I think really understanding how much the business actually keeps after all expenses is probably the most important place that I would start if I was looking at acquiring another business.
I couldn't agree more. We actually have some more questions too. And Yoshi, appreciate your question. That was an awesome question, and I appreciate having you on. Diego from before says, are there any certain sectors that you guys are looking at to target over the next few years because you see major sector shifts. Tech, AI, electric vehicles, and chips are obvious ones. Any other sectors? First off, I'll say on the note of tech and AI,
We just did an episode
Ryan
on
and Ryan and I actually have an episode that we pre-recorded that's going to come out either I think right before Christmas or right before New Year's coming up the next couple of weeks, where we were talking about tech and AI specifically. And there's actually a report that came out by a really major firm out there that found that there's a lot of private equity companies pulling out of deals that have a lot of AI exposure. And the main reason is because, in our opinion at least, we kind of did a breakdown of it. So check that one out when it comes out. But in our opinion, the main thing was that those industries they're so volatile and they change so fast. So to invest a lot of money in something that might be ruled obsolete in a few weeks by another breakthrough in the industry, it just feels a really risky. So we actually look to the most boring things you can imagine, right? Like we're talking about, and of course, no offense to the industry, but we're talking about dental practices right now. It's not like a sexy, flashy business. It's something that's very everyday, something that everyone needs. It's not something that's like, it's not something that's going to get disrupted overnight by market fluctuations. So things like that, like dental practices, things like HVAC, just your everyday businesses are the ones that we really like to look at.
Yeah, it's a great point, Brody. And I think to complement that as well, I actually think going into this next year, you're going to see a lot of the non-sexy products really boom. I think tech and AI, as great as they are, I think there's going to be a lot of steps that are taking away from that as a whole. It's not going to be as sexy as it's been for the last couple of years. Believe it or not, I actually think some of the hottest sectors that we're going to walk into are really going to be things around like oil, things around, I'd probably say, manufacturing. Definitely some of the chip stuff that was mentioned. I definitely think that's not going anywhere. But I actually have a really good pulse that we're going to have the biggest year of acquisitions of SMB businesses, small and medium-sized businesses that are just regular folk businesses, blue collar businesses, accountants, things of that nature. Any type of company that's just very easy to maintain and grow is really going to be something that you're going to see a lot of people buy into. And the reasons for that is because so many of them are so inundated and they just have such a good client pool that they don't even care to get new business. And a lot of them are outdated. So even if you use something simple like a CRM, like you can use the most simplest version of an AI software to respond to possible customers, and you're probably going to see an increase of like 15 to 20% of their books. So a lot of the guys that I'm talking with, a lot of the investors I've worked with, a lot of them are really interested in oil, non-sexy businesses, blue-collar businesses, manufacturing, things of that nature. And a lot of them are shifting into business services as well. So I actually think going into 25 and 26 is going to be extremely interesting in the acquisition strategy for a lot of PE firms, hedge funds, and individual retail investors.
It's a great note. And we actually have some follow-up questions here as well. Neil Acquisition says, what if a business has strong assets, but a downtrend on revenue? Is it worth looking into? This is...
I love that name too. Neil Acquisition. Yo, Neil, let's talk.
Ryan likes your name.
Dude, yeah.
So I would say if you're interested in that, that is not really a strategy that we're looking into personally, but there are a lot of firms out there that actually specialize in this.
Right.
It's not my favorite focus personally because we're more growth focused than focused on like taking advantage of assets and things like that. But there's a really good book called what is it? Merchants of Debt, I think is what it's called. That kind of details the come up of KKR back in like the 70s and 80s and stuff. And there's some good stories about that. Another good book on that is The Magic of Mergers book from around the same times, but there's a lot of firms that kind of specialize in that strategy. Just not one that we're into more so. We look more for like opportunities where we can actually grow the business. And the problem, in my opinion, with that type of strategy is that it's more focused on just kind of stripping out the pieces of value and like killing something rather than kind of turning it around.
Hey, yo, pretty woman.
That's definitely right on par, Brody. I agree with that completely. Also, let's reverse engineer this in a very simple way. If you have a lot of assets and declining revenue, what does that tell you about that business? There's a missing transition between sales and service, or sales and marketing, both of which are not good. So that means that at one point in time, this business was outperforming wherever it is now, which means they're on a downturn. And that's not necessarily a missed opportunity, because if it is just a marketing problem, then maybe you can just market them better and you can, blow the doors off that business. Or maybe it's a service problem, right? Which it probably is. And they just need to hire the right people or have better training. But a lot of times, whenever you see assets are outweighing revenue, that usually means that there's been a huge downtrend in sales, and also an increase in liabilities. And that's one thing that a lot of people miss. They just look at that and they're like, oh, this is obvious. It's a downtrend in sales. It's like, well, not necessarily. If you have increased liabilities, that's going to eat into your profit margins. And a lot of underwriting looks at that. So that could mean that they took on some sort of a debt and they're servicing that debt, which is why their revenue is down. So I guarantee you they had an increased DSR, debt service ratio, that probably happened somewhere between the last couple of years.
It's a great insight. Yeah, I think, always just looking between the lines like that and seeing like what might be causing this one thing that I'm seeing on the surface level. Like, what does the iceberg below the water look like is something you should be doing for any deal that you look at. And like you said, there's got to be a reason for that. Doesn't mean it's a bad thing. There might be something that you can really bring some expertise in. And, one thing that I love about how Ayman looks at businesses is he always looks at those three kind of key pillars of service, sales, and marketing and how they each interplay with each other. And most people are not good at doing all three of those. So there's often opportunities with businesses where you might be able to help with one or two that are not being done well and make it a completely different business with very little effort. Whereas that area might be very weak right now and causing the business to be in decline. And so always look for those opportunities. And if you look at a business and you see, wow, under my ownership, this would be a completely different story, then it might be a good acquisition for you.
Yep. Well said.
So we've got one more to look at, and let's just kind of like wrap on this one as well, because I know we've got a stop here coming up, but we've got a flourishing dental practice out of Riverside, California. Kind of the smallest one we've looked at, but this one is a very low price for the cash flow. What does that tell you, Ayman? Like, is that a good thing? Is that a red flag? What do you think when you see something that is less than a 2x multiple?
Tell me real quick what they're asking is.
Asking is 1.2 million even, and the cash flow is 745.
So most likely what that tells me is they're probably going off of productions, and that probably tells me they're trying to price that to sell really quick. So either a doctor is most likely exiting that strategy or that practice, and or there could be a partnership that is dissolving and the other partner just wants out. That is definitely priced to sell, unless there's something else within those numbers that they're not telling us, such as a debt service and or equipment service or something of that nature that they're discounting.
That's a good point. And we do have some more information at the bottom. It says that they're retiring, so that makes sense there. It could be that the most important consideration to them too is getting cash from the business, and that they're less flexible on the terms of the sale in favor of a bigger cash down payment. So if you see something low priced, I wouldn't be surprised if you get on the phone with them and they say, hey, we're looking for all cash for this, or mostly cash. Let's look in between the lines a little bit though. It looks like they've got 9 operating chairs.
That's good. That's actually really good.
Okay. That's good to know. So 9.
Anything above 5 is something that we really like to see, because that just shows you. So dentistry as a whole, one of the key ingredients that I personally use to judge how healthy it is something called CTMs, which stands for cycle time management. Cycle time management stands for the second a patient walks in the door to when they're sat, to when they see the hygienist, to when they're exchanged to the doctor, to when they come back up front and they leave. Most times, the quicker your CTMs can flip, much like a restaurant flipping a table, the more patients you can see within a day, obviously, the more revenue you're going to be making within that day, within that week, within that year, et cetera. So if you have 9 chairs, and let's say we have 2 doctors, that means that we can get them to run in between 2 to 3 rooms within 1 hour, because most doctors aren't spending more than 15 minutes in a room. And at that point, that means you could scale that operation really well. So 9 chairs, green flag, I really like that.
Nice. Okay. And 12 employees for that amount of chairs and that size of practice. What do you think of that amount of employees?
2 girls up front, 4 hygienists, and most likely they have, I would probably say, 2 dental assistants that are chair side. They probably have a periodontist that probably is working in-house, and then most likely somebody that's doing lab work, and then somebody that's doing billing. So that team is solid, and it sounds like they've probably been there for a long time. So that's a good spread number.
And if you dig into this a little bit, one thing I really like about this is they're showing how the numbers have grown over the last few years. Yep. It looks like it's in a good solid growth state as well. They show from 2019 all the way to 2022, good year over year growth from both like a gross revenue standpoint and net profit, adjusted net profit standpoint. So just always a good thing to see there. I'm probably going to send Ayman this deal afterwards too.
Actually, out of all the deals that we saw today, this is the deal that I would be really interested to see what's going on, because that deal right there, you could really work something really well with the seller. I actually love buying practices from people that are going into retirement, because not only do they understand what it takes to grow that business, they've been with it for so long, but the only reason why they're parting ways with it is because they're retiring. So the creative financing that we can use for that is really good. So for a deal like this, as an example, I would probably sit down with the doctor and explain to him that I would really love, or her, that I would really like to do something where we put a percentage down, and then we actually did an income driven type of buyout. And that would be a combination of seller financing as well as collection financing, which is very unique to this industry. And it's probably something they would go for, because they want to still receive income as if they're working. They want a little bit of cash flow to go, buy a house in Italy and hang out. So this is a deal that's a win-win for both whoever's buying it and whoever's selling it.
And a huge thing to your point, when someone is retiring, like it's about 2 things a lot of times, in my opinion, is like the one is they want to get out and get their time back, but the 2 is they want money for their retirement. If they're getting all of their money all at once and having to pay all of the taxes on all of that giant sum of money that comes with it in 1 year, they might not be able to really maximize their retirement quite as much as if they were getting it in installments through some kind of deal like he mentioned there over a few years. So seller financing or some like collections based financing like he mentioned could actually be really helpful to them in just spreading out the money that they get over like the first 5-10 years or so of retirement or something.
And Grant finally showed up and said, that listing says it includes real estate. Somebody owes the mob and needs to cash out today. So yeah, it's from Mr. Grant Barnes.
If you caught that, Ayman, that was about that last deal, I think. It's about how low it's priced and the real estate included.
Yeah.
I'm going to just show his comment here. He says somebody owes the mob and needs to cash out today.
Yeah, I agree with Grant on that 100%. I'm with him. I definitely think someone's ready for the payday.
I don't know much about Riverside, California, but if there's a strong mob presence there,
Well, we had New
it could
Jersey
be.
to kick this thing off, and in Camden, no less, which used to hold the murder capital of the United States for a number of years until it lost out to, I think, somewhere else in California.
So it could be about the mob here. These are the things you can only see if you look between the lines, folks.
Right.
And with this one in particular, I didn't see what the amount of real estate. Yeah, it does say price includes the real estate. So
Hey,
Oh,
whatever mob, bank, institutional investor, retail investor, they got to pay out. That's great for us because that right there is a crisis situation. This practice is price to sell, and 100%, one way or another, this is a good deal. This is hands down the best deal we saw all night.
that is assuming that the liability of the mob does not get carried with the purchase. You
True.
definitely do not
True.
want the mob to be on you after this one. But as long as you can make sure the mob gets paid out after this business gets purchased, then you're good. So on that note, finishing on the strongest deal, I always like to ask, what were a couple of your biggest takeaways from this episode?
From my perspective,
Yeah, what were a couple of like the biggest takeaways and like points of thought that you're kind of left thinking about after this?
so I would probably say as a whole, I think a lot of people that are in deal flows and that are selling a business truly don't know what it takes to really sell a business. Whenever you have somebody who has been in the game for, a few years and understands how this works, or is on the institutional side, or is on the finance side, the second we see a valuation that's absurd, we're not even going to call. We're going to just keep scrolling to the next listing. I think a lot of people that build a business fall into what I call the bubble syndrome. This is all they've known their entire life. So therefore they think this perceived value is higher than anything else that's out there. When in actuality, there's a million people that are in bubble syndrome that build businesses. So for guys and gals like us, we're going to just find where the alignment is. If we like the seller, if they're an honest business owner, if they're projecting numbers that are accurate. And so your first impression in deal flow, if you're looking at being acquired, is what you're stating, right? If you're stating a number that's ludicrous, I'm going to therefore think you're delusional. So I don't want to deal with that. I'm on to the next. But if you're understating your numbers like this deal that's in front of us right now, and you're being authentic within that self, and you're also remaining true to what it is that you're doing, well, then my ears are going to perk up and I'm probably going to have my team give you a call. I know, Brody, you and I have definitely been in various situations where we've been pitched by a lot of other businesses that are trying to seek our investment. And I know you've seen it firsthand where very quickly you can feel who is authentic and who is not. And so I think for a lot of people out there, if you're going to buy a business, just make sure there's good synergy between who you're buying the business from. Make sure that their numbers and their paperwork and everything is up to par. Because at the end of the day, you always want to make sure that whoever you're buying a business from wasn't doing anything that you're going to have to cover for the rest of the term. So I definitely think looking at those red flags early on and remaining objective is hands down the biggest takeaway. That if I could go back 15 years and give myself advice, it would just say, pay attention to the red flags. Know that if you miss the 8:30 train, that's okay, because there's an 8:35 one that's arriving. So never rush a deal and make sure whatever business you buy is right to where you are at the time of acquisition.
That's great stuff. I think a lot of people get into, I talked to someone not too long ago that rushed themselves into an acquisition, got into a situation where the seller had misrepresented a lot of things. And to add to that, the seller came in and went and told all of the clients that they had no idea who this person running their business was now, completely lied and really set them into a bad position. And they had paid all cash down for this deal. And so this person was just in a really, really difficult situation because they had rushed it. I think that's the same thing they would have gone and told themselves back before they made the acquisition is, maybe I don't need to make this one. Maybe I could keep looking, and what are the red flags that I'm seeing? So great note there. Ryan, how about you? Any big takeaways?
Definitely that the industries that we look at are surface level, very standard. but there's a level of detail I think that's unique to each industry that you can't truly understand unless you talk to somebody who's been through those trials by fire. And in this sense, we learned a lot about Ayman's background and bringing his expertise with not only, having, the importance of having a friend in the industry you're looking to get into, but also what we learned was basically the EBITDA. It wasn't really reflective of the actual thing, how they were phrasing certain words. And like you said, there's even certain unique financing ways that you can go about purchasing these. So everything on the surface can seem pretty boilerplate, but until you get into the nitty gritty alongside somebody who's either done business in the industry or works in it, you really should be careful about pursuing these too good to be true deals or interesting endeavors.
Great point. I love it.
Very true.
And on that note, Ayman, thank you so much for all your insight tonight. Where is the best place for people to find you and get to know you and ask you questions?
Guys, thank you for having me. Feel free to follow me on Instagram. My handle is Egyptian Made, which is MADE. I also am one of the managing partners for Zico Space and Clubhouse. If you're in Orlando, please feel free to swing by, where we create a space by entrepreneurs for entrepreneurs, as well as LinkedIn. You can find me by my name, Ayman Shamaa, with 2 A's at the end of that last name. Feel free to connect, message me, anything I can do to help or anything my team can do to help you look at a deal. We're all about supporting entrepreneurs where we can. And please feel free to reach out to either Brody, Ryan. They are extensions of kind of what we do as a whole. So I appreciate you guys. Thank you for everybody watching and listening and for the great questions. And it was a good time. I really enjoyed it.
Awesome stuff. And we'll be having Ayman on again sometime soon as well, probably early in the next year for a part 2, just to break down some more deals. He's got a really wide breadth of experience outside of the industries we covered tonight in all kinds of different industries. So be on the lookout for that. Be on the lookout for anything else that comes out. A couple of the episodes Ryan and I mentioned coming out. The next 2 weeks, we will be having pre-recorded episodes just because we'll be through Christmas and New Year's. So those are going to be some unique ones where we break down particular industries and some insights that I think you guys will really like. But as always, tune in every Tuesday night at 6 p.m. Eastern Standard Time to new episodes of Deal Flow Live. Thanks for coming on. You can find Ryan at...
Find me on LinkedIn, Ryan Santo. Just shoot me a note and we can talk. Love to spend time with people, chat about whatever you got going on.
And you can find me on pretty much any platform, just at Brody Vincent or brodyvincent.io on Instagram. Send us a note, send us a message if there's anything else that you want us to cover. Let us know if you want to come on the show and share your insights as well, or if there's any particular deals you want us to look at. But we look forward to seeing you on the next one.
Thanks, guys.
All right.
See ya.